fixed term structure flat as a pancake for, I was actually trying to look this morning to see where in history we've seen this level of flatness for an extended period of time, and I couldn't come up with an analog.
So we are inside the 1 month window of the election. That means that the VIX now captures the election, so there's an elevated component to the VIX, and volatility on a realized basis has not done anything particularly special since August 5th or so.
I go back to the beginning of the year where we saw the October hump in the futures term structure, and everybody was asking, well, wait a minute, the election's in November. Why are we seeing the hump in October?
The shorter and shorter dated derivatives have magnifying characteristics to them, but it's awfully hard to have a systemic impact. Do you see the current environment similar? I've been way too cautious about this whole thing. I think most of us have.
Well, it's interesting because the sort of the one cross asset indicator that I pay careful attention to are credit markets, because historically credit markets have been that canary in the coal mine.
Mike Green, I'm here at the Collective here with Jim Carroll. Jim, we're in the South. Your native area, staring out at St. John's Island, Kiowa Island, which is where you currently live. We've been talking markets. We've been talking what's going on. I don't have a clue. What do you think's going on?
I wish I knew. It's really feels to me like one of the stranger times that I've experienced. Stonks go up. I spend a lot of time staring at the volatility complex, and it's really struggling to provide any signals. We've seen the fixed term structure flat as a pancake for, I was actually trying to look this morning to see where in history we've seen this level of flatness for an extended period of time, and I couldn't come up with an analog. But it seems to be the kind of the ultimate in indecision while we wait for this election. But I don't know if it's going to change after the election.
Well, we keep waiting for that, right? So we keep identifying potential catalysts for it. And this is clearly one of the things that is playing through right now, is that we're now officially October 7th. So we are inside the 1 month, window of the election. That means that the VIX now captures the election, so there's an elevated component to the VIX, even as equities are higher, and volatility on a realized basis has not done anything particularly special since August 5th or so. But we are sitting at elevated levels. Suddenly we're inside. One of the things you and I were talking about is the dynamics of the zero data expiry options, which are not truly zero day. They're released 2 weeks ahead of the event. And so we've still got kind of 2 weeks of this indecision in which it's this amorphous, blob of, well, we think there's volatility on the horizon. And then kind of over the next 2 weeks, we're going to get to see those 0 days begin to emerge. You see this, I think, similarly to me, that ultimately that should provide a little bit of a catalyst for the resolution of where that volatility ultimately sits. Does that seem?
It will. And I go back to the beginning of the year where we saw the October hump in the futures term structure, and everybody was asking, well, wait a minute, the election's in November. Why are we seeing the hump in October? And I don't have to explain it to you, but we're now at that point where it's all kind of coming together. And it's often the case that when there's a kind of a pinpoint event, a Fed meeting, we've now got labor reports. Everything can now be expressed with a 0 day option. And then we get this sigh of relief, typically, right? We have a little buildup and then a sigh of relief. I don't know if we're going to have a sigh of relief around the election. And I see this just flatness, this no premium for term insurance in the term structure. Everybody who's selling volatility is either selling it structurally because it's embedded in some product that they're creating, but it's not clear to me that quote unquote traders or speculators are selling, at least they're not selling the front end, because otherwise we would have some contango in the term structure. We just don't have it.
Yeah, I mean, I talk all the time about a hedged pot rarely boils, right? And so my gut tells me that we're set up in this environment and that this is actually causing part of the weighting, right? It's really expensive to hedge on a 1 month basis. We're just going to kind of sit here, and kind of roll until we resolve some of this stuff. But one of the things we were talking about with the group here is whether the election actually does resolve anything, right? It really boils down to how close this is, right? So do we wake up on Wednesday morning, as we did in 2016, and we're immediately able to say, okay, the election is over, and oh, by the way, Donald Trump didn't crash the stock markets; he caused a rally. Or are we going to wake up in the same way this time and say, okay, one of these two, I'm not even sure I can say their names anymore, right? But one of these two has now risen to the highest elected office in the land, and we immediately resolve the problem and we move on. It doesn't feel like that's a given by any stretch of the imagination.
It certainly doesn't feel like a given to me. And I'm not a macro guy, and nor am I a political guy. But it strikes me that whichever way, and part of it does revolve around control of Congress. Because if we have a split or we have unity, that will make a difference. But I think once we get a sigh of relief, one way or the other, just a finished election, and hopefully whatever direction it takes in a peaceful fashion, then we really have to see what unfolds, right? I remember 2016 vividly, and oh, wow, Trump won. But the market interpreted that very positively. We were off sailing, and I remember getting short vol 2 days later and running that right into January or February. And, we may see the same thing here where there is a collective sigh of relief. I wonder, though, because then we get into the question of, okay, so what are they going to do? And how do we think that's going to affect markets? Is that going to be smooth sailing? Do we have, continuation of new highs? Or do we introduce some volatility because of the programs that are going to come out? Waves of fiscal spending, concerns about debt and debt service, and the inflation boogeyman that everybody seems to continue to be very concerned about. I think from my perspective, almost everything I do has an element of periodic adjustment in it. I am not a buy and hold investor. And so I comfort myself saying, I have no idea what's going to happen, but the markets will help me gauge what's going to happen, and I'll change portfolios to adjust to whatever does come down.
Well, from a volatility perspective, right? I mean, volatility by definition is always priced implied versus realized.
Yes.
And so it really just becomes a question of effectively probabilistically saying, do I think we're going to realize these elevated levels of volatility? When it's expressed in a single day form, that answer is known by 4:30 p.m., right? 4:15, I guess, technically. When it happens in a monthly or a 6 month, like this is one of the things that again, you and I have talked about in the past. But if I take myself back to the global financial crisis, a lot of the events and behaviors that emerged out of that were a function of people entering into very long dated contracts, right? Mortgages, 30-year contracts. Even if you're anticipating paying it off and moving in 10, it's still a long dated contract that you've entered into. 10-year variance swaps became very popular products. Even 15-year variance swaps became popular products for a period of time. And the bid for those, you and I both distinctly remember, seeing as late as 2012, mid-30s bids for 10-year variance contracts, right? Which would have implied that every day for the next 10 years was something like the 3 days after 9/11, right? Like these just felt like insane things, but they were very long-term contracts. One of the things that I point out to people about today's shortfall selling is that it's literally the pennies in front of the steamroller, but they're short-dated contracts, right? So they're one-day contracts. So when I look back on August 5th and the blow-up of the dispersion trade, which was peripherally tied to the Japanese yen, but that whole nonsense about the unwind of the Japanese carry trade, like I didn't see that. I don't know if you saw it, but it's...
I certainly saw the yen move, and you get knock-on effects, right? It's not always clear that what the root cause of a disruption is, and there were plenty of people talking about the yen and dispersion and once again, it's, to me, it was not unlike the last big one, Volmageddon, in that if you were paying attention, you didn't get run over by the steamroller. There were a lot of people who got run over by the steamroller. They weren't paying attention to the same things that, a trader would be. And it rebounded more quickly than anything in history.
Yeah.
So it was sort of like, did that actually happen? Did I dream it?
Yeah.
Because it was over in 2 weeks.
Well, again, we've been talking about this all morning. There were a couple of things that really stuck out on that day for me, right? One, for me, with the key unwind indicator was the pricing of implied correlation for those low delta, basically 1 month exactly, right? Which told you the contracts that everyone was short. You saw the implied correlation on the S&P for a 10 delta put, 1 month put, climb to 240%, right? Now, for those in the audience that aren't paying close attention, an implied correlation of 240% makes absolutely no sense in the traditional mathematical sense, where correlation tops out at 100, right? So 1%, a 1 in terms of a correlation factor. But because these are not actually traded instruments, right? Nobody's really going out there and playing the correlation trade. They're simply bidding for index options, or they're bidding for single stock. If the bid for index options explodes relative to the bid for single stocks, that shows up as correlation above 100%. But this was an extreme move. It was extremely isolated within the equity volatility space. And as you point out, relative to Volmageddon, honestly felt like a non-event, even though it was over by the end of the day. It was
again, if you were simply shocked by the awe of that move, and weren't looking at other measures of the market, you could have been, on the ledge or off the ledge. Yep. The flip side is it was so out of sync with so many other elements of what was going on in the market that you really kind of had to shake your head and say, that doesn't make any sense. I'm not sure exactly what happened, but I don't see that as fundamental. And so the quick repair was amazing, but it really wasn't shocking even with a little bit of hindsight.
No, I actually completely agree with that. I would argue that even the hindsight itself, like once you make it through one of those events, right? I mean, the minute you discover that you're not decapitated in the accident, like, okay, I'm alive. Let's figure out what to do next, right? But I've shared with you that again, right? I've highlighted this a couple of times in the past. Like among the scariest things that I ever see are the self-congratulatory notes that come out of Vanguard, right? And so, true to form, on August 7th, I think it was, Vanguard released a self-congratulatory note that pretty much explained almost everything that we saw, which was less than 2.5% of their client base tried to transact in an unusual way on that day, and the buys outnumbered the sells 5-1, right? Like, I've likened the zero data expiry, or the short dated option contracts, as being very different in terms of the weapons of mass destruction that Warren Buffett had talked about with derivatives, right? A long-dated derivative contract is something in which you've embedded assumptions for a very long period of time. And so if those assumptions end up being wrong, that can wear with you for a very long time, right? I lent money to my cousin for the next 10 years, and I'm literally going to be anxious about whether I'm going to get paid back over the next 10 years, right? If he promises to pay me tomorrow and he doesn't do so, I'm like, all right, he's a deadbeat. I was right, and I probably scaled everything accordingly. This is the same sort of thing. I like to talk about it as like the difference between a mass shooting or a weapon of mass destruction and basically Russian roulette, right? You can shoot yourself in the head without particularly systemic effects. Obviously, your loved ones will be upset about the process, but it is radically different than what we've seen up to this point, right? These shorter and shorter dated derivatives have magnifying characteristics to them, but it's awfully hard to like have a systemic impact. Do you see the current environment as similar?
I'm still, yeah, and to be honest, I'm still trying to figure it out because I'm not maybe the smartest guy at the dance. It strikes me that the shorter dated options serve a great function for people who have very specific needs to express either a hedge or speculation. And what we've learned about it is that the market makers have kind of sorted out how to deal with all this stuff. I think initially a little bit of shock at the interest in using these things, but the market makers are smart. They've got great technology, and they're able to hedge 0DT with 0DT and call it a day. I think I continue to think that there's a little bit of jump risk in the sense that if I'm hedging using 0DT, and as you point out, I can now say, okay, this thing's happening 2 weeks from today. I've got an option that expires that day. I can express my whatever I want to express, pinpoint it to the event, and then, we start over again. But then if in that interim period, something bigger happens and I say, oh crap, I need to now go further out, those same market makers are sitting there saying,
you're going to pay a premium.
Yeah, we will lift those option premiums and you'll just have to pay more if you want to do that. And so I think the reaction function that begins because people said, well, VIX is dead, because 0DT is taken over and the options that are in the VIX construction don't matter anymore.
Yep.
Until they do matter.
Right.
At which point, and we've talked about this, the last several years, we've seen a less responsive VIX to a change in S&P. And this year it seems to be getting a little more responsive, as though maybe people are thinking, gee, maybe I need to express some desire for insurance a little longer dated than I have been. We've created a very dynamic system. I expect that participants are just going to have to be that much more nimble in taking care of business.
Well, one of the things that I noticed, and to be very clear, I actually completely agree with the points that you were raising. One of the things that I noticed about August 5th was that was also the day that 0DTEs just didn't trade, right? So you saw the market makers come in and fully exploit that dynamic where everyone's like, oh my God, I need to hedge what's going on right now, right? This is the unwind of the Japanese carry trade or whatever people were labeling it at that time. Get me in now. And the market makers just basically looked at it like, you're joking, right? We're not letting you have these things.
It's 8:30 in the morning. I haven't had my coffee yet.
Exactly. And so you saw effectively the bid ask blow out to just an extraordinary degree. If we'd properly priced zero data expiry options, you probably would have seen a VIX north of 200 is the equivalent. And candidly, they just didn't exist. Right. And so that to me was kind of like, that's a little bit of the warning sign, right? That's the U.S. housing market in 2007, where it relies on the ability to sell synthetic RMBS. And without that additional liquidity, the market starts breaking, right? I definitely think you saw a component of that. You referred to one of the things, we had a discussion about things we're watching, right? So for me, going into the XIV trade, when I did the trade around that Volmageddon component, part of what I was watching was the beta of the VIX, or the UX futures to be more precise, to the S&P itself, right? And historically, that's traded in kind of the 4 to 8 range, suggesting that the VIX is the equivalent of 4 to 8 times levered versus the S&P. Well, the key thing that I was monitoring, that I was watching, was that you were actually seeing that beta rise as more and more of the volume was pushed through the short volatility space. Effectively, it became twitchier and twitchier and twitchier and twitchier. Mm-hmm. And in that environment, the beta of the S&P, or the beta of the VIX relative to the S&P, rose to, I think it was 24 roughly, right? And so for those who have heard me talk about the trade in the past, right, the math was really simple. If you need to get the VIX to double, you need to cause something that would actually result in that. Well, if the beta is 24, that means that the VIX only has to go up 4% to have a 100% drawdown. Or the S&P only has to go down 4% in order to get a 100% drawdown in the VIX, and by definition, the XIV. Now we've actually seen almost the exact opposite. It's started to pick up a little bit, but we're actually seeing the VIX beta to the S&P. I talked a lot about this in Tier 1, has basically gone to zero, right? By jokingly referred to as Volmanutton, right? And so it doesn't really seem to matter. Now, there is an interesting interpretation of this, and it actually holds water if I compare other asset classes like high yield, like small caps, et cetera, which is that the beta of the S&P is effectively rising, right? What's your reaction to that?
Well, my observation is that, you see it in the numbers, and, some people, myself included, kind of a little bit of a head scratcher. We search for what's different. And so it's easy to say 0DTE is different and therefore that must be it. But I wonder, if this is something, is this a change to market structure that we're experiencing, or is this just a period where realized volatility in the S&P is very low, and therefore who cares about, volatility? Who cares about hedging? Who cares about, we need maximum exposure to this S&P 500 thing, maybe the Qs, certainly not small caps. And the beta exists in the underlying rather than in the derivatives.
Well, right. And so, for those in the audience that are kind of following this conversation, right, to talk about the beta of the S&P is a little bit nonsense, right? Because
it's supposed to be one.
It's supposed to be one, right? Theoretically, it's supposed to be one, but that's not really true because the S&P is a proxy for the market. It is not the true market itself, which includes private assets, the S&P, everything else, right? And so, in large part, the way we calculate it, it's not observable to say that the beta has become greater than 1. But given how we're seeing other asset classes behave, that actually is a pretty reasonable interpretation. I think it's kind of where I come out. And so that is one of those things that I'm watching. I'm like, I'm not sure it's quite at XIV type levels, right, but this is interesting. This is interesting that we are seeing the beta of everything else start to fall versus the S&P. The other thing that kind of jumps out at me, and you were talking about this, we were talking about this earlier, is, particularly anytime you're sitting down with Pippa Malmgren, she's the first person to highlight, here's the new amazing things that are happening in the world of technology. And yet, as I listen to Pippa talk about all of this, all I keep thinking is this, terminal value should probably be compressing in this environment where the uncertainty of what Pippa is highlighting, the world could be a very, very different place. We should see terminal values compressing. We talked extensively about the auto market, right? And just do the thought experiment, right? If you know that there's going to be perfect self-driving cars 13 years from now, are you more or less likely to buy a brand new car, right? Well, maybe today, because I'm saying, okay, I got 13 years left, I'll buy a car. But 6 years from now, I'm far less likely.
And your discount factor has to be going higher.
Higher and higher and higher.
Right. Yeah. Not to mention all the geopolitical tensions, and we just seem to have a Teflon market at this point in time, and which comes back to your favorite topic, which is passive flows.
I'm bored out of my mind on that, but no, it does unfortunately fit the fact pattern. The one thing that I would actually add to that, of course, is that we're now seeing again, in the scary Vanguard responses, right? If you look at their chief strategist forecast, they do their asset allocation frameworks like everybody else. And their conclusion is equities offer a relatively unattractive return going forward. But if you actually survey Vanguard investors, which Vanguard, of course, does, they're wonderful in that way, what you discover is their expectations for returns are actually rising. So the central expectations for Vanguard's customers right now at a 10-year horizon basically hit like the 95th percentile for Vanguard strategists.
Well, it's interesting because whether it's Vanguard or GMO is famous for their asset class forecasts, and I remember back in 2015, it seems quaint, looking at these forecasts for stocks and bonds and thinking, wow, where am I going to get return in my portfolios? Which was actually what got me into the whole volatility space. But I feel it, I hear it from clients and talking to other advisors. The expectation of portfolio returns is, to me, getting back into that unrealistic zone where, most advisors aren't looking at fundamentals anymore. Maybe they know what the forward PE ratio on the S&P 500 is, but they're certainly not doing fundamental analysis on the component companies. And all they're hearing from their clients is, where's the beef? The S&P's up, the Qs are up. How come I'm not up there too? So there's immense pressure that effectively converts what could be somewhat more active portfolio management into a more passive approach.
Yeah, you have to have your S&P allocation, right? And you can't run short on that because it's the one thing that can really get you fired by the client.
Right. And maybe what you do is you try to sneak some XLK in there or some, now that we've spread them around, a little communications, a little technology, a little consumer, because that's all Amazon.
Right.
Maybe you pepper a little bit of that into your portfolio.
You certainly wouldn't call them the Mag 7, but you would put them
exactly.
in there. Right, yeah.
Exactly. Or maybe you'd make the wild call that you should have a direct interest in NVIDIA in your portfolio. You're certainly going to increase the volatility. Maybe you'll increase the return.
Well, this is one of the great features of markets, right? Is that there's a combination of foresight and hindsight. And so you could have done all the right analysis on NVIDIA and you would have come to the conclusion that you should definitely own NVIDIA. And my guess is that if you had done an absolutely fantastic job, you would have said, okay, I'm going to make it 3% of my portfolio. And as it doubled and doubled again, you would have been taking profits and reducing your position. And you're probably now underweight NVIDIA, even though you had made it a feature of your portfolio.
Right.
So this is definitely one of the things. Now, you mentioned that you got involved in volatility because you were trying to figure out ways to break out of what felt like a low return environment. Obviously wrong in its analysis, but that's okay. I've been there. When you talk about using volatility as a source of returns, what does that mean to you?
Well, to me, I looked at it and said, are there... I've tried to be systematic in what I do. I take an active management approach and went through my baptism, in the global financial crisis where I had a lot of allocation to value investors because that had worked tremendously for me in the past. It struck me that, these guys were having their heyday because everything they loved was getting cheaper. So let's just go buy more. But I decided that I needed to broaden my horizons, discovered a lot of additional work around momentum trend following, tactical asset allocation, and began to develop some ways to implement that in portfolios. And then tripped over a bunch of work that had been done in the volatility space, basically expressing either a long or short approach. To your point, short volatility is really long equities with a beta of pick a number. And so
currently 2, historically 8.
could
On occasion,
be
24.
but gee, is that could that be an equity substitute? Wall Street, in its kindness, had developed products like XIV, for which I had a use case. And so really for me, it became another systematic strategy where I could allocate either long or short using these products. And oddly was happy to use those products even when all the smart kids were telling me that I should either be trading options or futures. I figured if nobody else wants to use these, that's probably a good thing.
Yep.
They'll leave me alone.
Yep.
So it really is just another kind of puzzle piece that I can use in constructing portfolios where there's an understanding and a risk tolerance, because volatility is volatile, even in the best of circumstances. It really is it's a trading strategy, and not very many people are comfortable with trading strategies.
Well, I mean, as you're describing it, right? I mean, it really is a source of return for you. So one, you're, again, using it largely as a substitute for being long equity.
Yes.
So doubling up on that is probably not the right solution. I know at Simplify, when we do our short volatility approaches, there's a couple of things that we embed in there, right? One is that we don't actually dollar cost continuously average in, right? So we're constantly redistributing the profits. Part of that is because of the negative convexity that's built into the strategy. You can very quickly make 15% return, and you can very quickly lose 85% return. If you lose 85% and you haven't taken your money out, it becomes almost impossible to get back to ground zero, right?
Yes, it does.
So you can change the structure of that product. The other thing, though, that you always want to think about when you're doing short volatility is this shots on goal concept, right? Which is if 85% of options expire worthless, which is pretty close to the accurate number, or at least the historical empirical number, you want to do that as frequently as you possibly can, right? It's a little bit akin to the analogy that stocks typically go up. Right. Well, if I make money 85% of the time when I sell options, I should probably do it as much as I possibly can. But I also want to scale each individual bet so that it's not catastrophic.
Yes.
So that's one of the nice things that ultimately plays out. But the other thing that I always highlight for people is that the entire idea behind options is to modify a return profile so that it looks like something else you know, right? And this is, to me, one of the more interesting things that exists out there, right? Which is people will very quickly say, I want to engage in call overwriting, right? Well, just think mechanically about what you've done. You own the underlying security, so you have all the risk of the downside. I've sold the upside participation component, right, in the form of a call overwrite. I'm capturing some premium associated with that. The payoff structure there, which is I can lose money, I can break even and make slightly more. You've just created a bond. Right? You've underwritten a bond on an asset that you may think is higher quality than the other corporate paper that's out there, but you're in control of the tenor, you're in control of, some elements of the collateral gets posted, but you've really just created a bond. And this to me is like the most fascinating thing that I see out there is the prevalence of synthetic structures, synthetic bond approaches. It tells me that the baby boomers in particular desperately want income. They desperately want fixed income products.
Yeah, the other thing we're seeing along those same lines is, again, for people who look at the way the market's been behaving and say this can't go on forever, is the construct where I instead of collecting the income from selling the call,
you buy the long dated in the money.
I buy the put.
Yeah.
So I protect the downside because if you look at Innovator was got out ahead, but First Trust is catching up, and everybody else is coming out with these defined outcome products, and there's a lot to be said for them in certain use cases.
Yep.
But again, I think the challenge is, or one challenge is that I think there are quite a few advisors using them who don't fully understand them. And if the advisor doesn't understand it, then the client certainly doesn't understand it. So, we're still in the early innings of these things gaining a lot of traction and momentum. only time will tell, how they play out as markets push them in either direction. It'll be great if you've got, 100% protection on the downside and the market crashes. You're going to think my advisor's a genius, because I had no downside at all. If the market continues to skyrocket and you're capped at 7%, that's not going to feel very good.
Well, the one that keeps capturing my attention, you mentioned things like buffer funds, et cetera, right? And so these strategies actually really only work in periods in which there's a combination of relatively high interest rates and relatively low implied volatility, right? And so if I think about what I'm actually building in that structured product, I'm taking advantage of the fact that the short-term 1-year paper is give or take 5 cents on the dollar, right? So I buy a 95-cent bond. That 95-cent bond will appreciate to par over the course of the next year, right? I then take that 5 cents that are left over and I go buy a call option on the S&P, basically at the money, right? So I capture 100% of the upside in the S&P using that 5%. It looks like a totally riskless structure, but really what my risk is that I've foregone the income associated with that high interest rate environment.
Right.
When you think about clients and you think about the advisors who are making this pitch to them for these types of strategies, is that broadly understood that effectively you've given up the potential to participate in the bond in exchange for the equities? And where does that fall on the risk tolerance framework, right? Is that risk-free or is that actually risky? Because I'm not entirely sure.
Well, and I think the providers, Innovator in particular, I think, has done a great job of providing a menu that allows somebody to really try to tailor this thing. You've got quarterly resets, you've got monthly resets, annual resets, 2-year resets. And I think somebody who's reasonably sophisticated with options and understands that structure could actually tailor something that would make the client very happy. I've limited my downside. I'll capture upside that's consistent with my objectives. Forget what the market might return. I don't care. I don't need 20%. If you give me 8%, I'm happy. If you limit my downside to pick a number, because you can literally say, pick a number and I'll limit your downside to that.
Yep.
And so I think, you just look at the explosion in assets under management at these places, and there clearly is traction.
Well, yes.
And by the way, my CIO was a derivatives guy at Goldman Sachs. He says, we can do those ourselves. To which my response is, you're going to trade those every day?
Yeah. Well, as a firm who does do similar stuff,
right,
absolutely hats off to them for that innovation. These have been standard products in the structured product world for a very long period of time. That's really been one of the key things that ETFs have done since the introduction of the derivative rule, is take products that were historically only available in the private wealth areas and democratize them, right?
And strip some of the fees out of them.
Strip a lot of the fees out. They're much less expensive. But on the flip side of that, when I think about that underlying structure, right, what I've really done is I've bought a call option, right? I've got a structure in my portfolio that is an equity replacement because it gives me the upside participation going forward. When I start talking about selling call options, I've created a synthetic fixed income product, et cetera. When you think about those payout structures and the fact that now we're crossing lines and using synthetic approaches to turn equities into bonds, and equities and bond structures or bond structures into call options, right? I mean, we're going all over the place here. This is almost like my sophomore year at Wharton in terms of, option theory sort of stuff. Are we adequately explaining to clients what we're doing? And are we thinking properly about how to build the portfolio, given that we're no longer constructing kind of a traditional asset class portfolio, and increasingly it's a product that's composed of multiple ladders of structured products?
Yeah, I am concerned, and we've been slow to adopt them for just that reason. Are we really thinking carefully about where this fits in what it does to an overall portfolio construction. Are we using it as a core element? Are we using it as a satellite element? Because, again, if you were an advisor at Goldman, UBS, Morgan Stanley, you had structured product desks that were stuffing this stuff down your throat all the time. I happen to know that even those people don't fully understand what they're feeding their clients. So I think there's still work for most advisors to do to make sure that, A, they understand what they're doing, where it fits, what the proper use cases are. And then I wonder how many clients actually really understand. I think it's a relatively small number.
Yeah, that's kind of my gut.
I'm just going to jump in here for 1 second. Shannon, you can come in.
I think that was my wife, actually.
Could be your wife. Shannon just texted me saying she was out.
Oh.
So,
All right.
Are we done?
I think we've got like 3 minutes. We've talked about
40 minutes.
All right. So when you think about this issue of client education, explaining these products, et cetera, like, in all honesty, do you think you can? Do you think that can be done, or is this just a function of these things are hard? Like these are actually complex products in a lot of ways.
Honestly, there are some clients who have a level of financial sophistication. Maybe they worked on Wall Street. We have people who
Sure sound they have no idea what they're talking about.
Well, exactly. But again, there is a suitability question. There's frankly a client tolerance to understand. Mm-hmm. Some of the things that I do, I say, okay, we're going to sit down. I'm going to explain this to you. And about halfway through, they say, Jim, you can stop talking now. I trust you. And part of it is how are you managing the overall risk of the portfolio, and what risk do you think this component is contributing to that overall risk? Because for me, just going back to volatility for a minute, people say, well, you must hedge that. What are you doing? Are you doing this? Are you doing that? I'm saying, let's talk about position sizing.
Yeah.
Because that's the other way that you can isolate the risk of something, is to say, if you own 1% of this in your portfolio and it goes to zero, that's probably acceptable. If it works, it's some multiple of 1%. And so I think, even with anything that a client may not understand, it either doesn't belong in the portfolio or it belongs at a size where over time the education process can play out. The client can be comfortable. Oh, I see what it did there. You have a couple of market scenarios that test the upside or downside of a structure, and the client can become more comfortable, and then it may make sense to increase the size of something like that.
Well, the other thing that I would highlight about this is, and you and I were talking with a group earlier today at some of the collective events about exactly this issue, right? Which is this difference between an ergodic system and a non-ergodic system, the difference between an ensemble average and a time series average, right? And so I think you and I both completely would agree that a short volatility program implemented on a systematic and thoughtful risk level will work fantastically well over time. But if you, as an advisor, pile all your clients into short volatility at the same time, they're not going to get the asset class return over a very wide period of time. They're going to get the specific experience to it.
Right.
And so there is a really distinct difference between those two. One of the things that I keep coming back to is this observation that because we build and operate in markets as if they are ergodic, where the time series average is the same as the ensemble average, that effectively we're underbidding for the insurance for that time series component, right? And you see this manifest itself. I would argue that the expectations for higher returns coming through the Vanguard community are just another one of the ways of saying the same things, right? Like,
yes,
the group that's there hasn't seen a significant bear market of any magnitude for an extended period of time. They have correctly been rewarded for every buy the dip performance. And the returns that they've realized in equities under almost any time period, except for maybe the very short window of, March 2020 until March 2024, delivered returns that are far in excess of what almost anyone should have expected from these markets.
Right.
And so naturally, they're raising their expectations of it.
Mm-hmm.
The question for me is ultimately going to be what causes that to reverse, or does it ever, right? Because one of the scary things about some of my work is if the flows don't turn, this could continue.
Yeah. And we can't know, obviously. And I think the approach that I've taken is to say, I can't know, but I can look for clues on a routine basis and systematically adjust exposures as the evidence presents itself. And hope that past and prologue bear some resemblance. We'll find out when we get there.
Yeah, no, I definitely think we will. And the point that I would make, you and I were again discussing this point, there's a number of things out there that are kind of at the stage where you and I would be like, that's weird, right? Oh, you just said that Hong Kong fell 9% overnight. That feels odd.
Wasn't it just up 10%?
It was just up 10%, right? Yeah, I think there's a lot of confusion. There's a lot of that sort of that's going on. We mentioned earlier this dynamic of the potential for an increased beta to the S&P. So these are all things that I'm watching, but I got to be honest with you, I've been way too cautious about this whole thing. I think most of us have. So.
Well, it's interesting because the sort of the one cross asset indicator that I pay careful attention to are credit markets, because historically credit markets have been that canary in the coal mine, and they have just refused to show any signs of real stress. And
which is actually really ironic because I also track them very closely. I run a high yield credit fund that's done, we've managed to navigate this reasonably well. The thing that I would notice is that amongst all the risk indicators, right, ranging from the VIX to FX volatility to oil volatility to the MOVE index, which my partner Harley Bassman created as the VIX for rates,
right,
every single thing is elevated with the exception of credit spreads. Credit spreads are kind of like 1.5 standard deviations tight. And it's particularly perverse because bankruptcies are elevated and delinquencies and distress and credit metrics are beginning to deteriorate in portfolios. But at the end of the day, credit themselves, I can't help but think that part of this is just a function of that's where it happened last, right? Mm-hmm. So everybody watches the credit markets. I kind of wonder if we're watching for the last, if we're diligently manning the guns on the Maginot Line, right? Those Germans, they're going to come this way, and just you wait, right?
Well, and one big difference, as you understand, is that a lot of credit has moved to private credit, which is not reported the same way. So I have started to pay attention to non-accruals and all the people who have to report non-accruals in their private credit portfolios. And
we're starting to take up a little bit.
A little bit here and there.
Yeah, no, we're definitely seeing the performance components, but it is not showing up in the pricing yet. And again, like you've heard me say this a million times, we're a narrative species. I would argue that a lot of what we're actually trying to do right now is explain the behavior of the S&P as compared to what the economy is actually doing.
Right.
Jim, this was fantastic. You were an incredible host bringing us down here to South Carolina, where you are currently located. Glad we could hang out with you. And as part of the collective, I'm thrilled that we were able to do this.
Thank you, Mike.